Why is every breakout obvious in retrospect but invisible in real time? You look at the chart after the fact and think, how did I miss that? The setup was perfect. The volume was there. The consolidation was textbook. But when you were watching it live, you hesitated. You doubted. You waited for more confirmation. And by the time you were certain enough to act, it was already extended. Here's the brutal truth. You can't spot breakouts in advance by looking for certainty. Certainty only exists in hindsight. The traders who catch breakouts early aren't more certain, they're more comfortable with uncertainty. They've learned to recognize the conditions that precede movement without needing the movement to confirm it first. And that recognition isn't about patterns, it's about psychology, market psychology, and your own. You've been taught to spot breakouts by identifying patterns, triangles, flags, rectangles, cup and handles, and you've learned the textbook way to trade them. Wait for the breakout. Enter on the close above resistance, set your stop below the pattern, target twice the pattern height, and sometimes it works. But most of the time, you enter the breakout, it runs for a few bars, then reverses and stops you out. Or worse, you hesitate because you've been burned so many times, you wait for confirmation, and by the time you enter, the easy money is already made and you're buying at extension. Here's what nobody tells you. Patterns don't predict breakouts. Participation does. A triangle on a chart is just price drawing a shape. But a triangle with increasing volume into the apex, with buyers defending the lows aggressively, with order flow showing accumulation, with options activity signaling conviction, that's a different animal. That's a coiled spring. And you can see the coiling process happen in real time if you know what to look for. The core pain we're addressing is this. You're tired of chasing breakouts that fail. You're tired of missing breakouts because you waited too long. You're tired of not knowing whether this consolidation is the one that runs or the one that fakes out. And you've been looking for the answer in pattern recognition when the answer is in market structure. The chart shows you what happened. Market structure shows you what's likely to happen next. What makes this different is we're not teaching pattern recognition. We're teaching structural analysis. How to read commitment. How to identify when a consolidation is preparing to release versus when it's just drifting. How to see accumulation happening before it shows up in price. These aren't chart patterns. They're behavioral signatures. And once you learn to read behavior, you stop needing confirmation because you can see the setup building in advance. The myth we're busting is that you can spot breakouts early by finding patterns sooner. You can't. Everyone has pattern scanners. Everyone sees the triangle. The secret isn't seeing the triangle. It's knowing which triangles have fuel and which ones don't. And fuel isn't a pattern. It's a condition, a structure, an imbalance between supply and demand that's about to resolve violently in one direction. The reframe is this. Breakouts don't happen because patterns complete. They happen because one side gives up and the other side overwhelms them. And you can see that capitulation process beginning before price breaks. You just have to know where to look. Let me tell you about a breakout I caught in real time that taught me everything about how this actually works. It was a stock that had been consolidating in a tight range for 3 weeks. Classic setup. Higher lows, flat resistance, volume declining, textbook bull flag. And every day, more traders were entering long positions, convinced the breakout was imminent. But here's what most people didn't see. Every time price tested resistance and failed, those recent buyers were getting trapped. They bought near resistance expecting the breakout. It didn't break. Now they're underwater. And they're either holding and hoping, or they're setting break-even exits just below their entry. Meanwhile, sellers keep defending resistance successfully, emboldening more sellers to join. Then one day, something changed. Price dipped below the recent lows, triggering all those break-even stops from trapped longs. Cascade of selling. Price dropped hard. And everyone assumed the pattern failed, the breakout wasn't going to happen, time to move on. Except I wasn't watching the pattern. I was watching volume and order flow. During that washout, volume spiked. But the selling wasn't distribution. It was capitulation. Trapped longs were exiting. Weak hands were shaking out. And then, at the lows of that move, Buying absorbed everything instantly. Price snapped back into the range. And now, all those trapped longs were out. All those confident sellers just saw their breakdown fail. And the buyers who absorbed the washout, they weren't scared. They were committed. Next day, price pushed through resistance like it was never there. And it ran 30% in 2 weeks. Why? Because the washout cleared all the weak holders. The breakout happened from a base of conviction, not hope. And I knew it was coming because I watched the weak hands get flushed and the strong hands step in. That's not pattern recognition. That's understanding market mechanics. And I want you to really understand what happened there. The pattern watchers saw that breakdown below support and thought pattern failed, move on to the next one. But I saw something different. I saw a consolidation that had been building for 3 weeks suddenly get tested violently. And that test revealed something critical. It revealed who was committed and who wasn't. The people who sold into that breakdown, they weren't committed. They were hoping. And hope doesn't fuel breakouts. Conviction fuels breakouts. So when I saw the buying come in at the lows, when I saw price snap back immediately, I knew something had changed. The base was no longer filled with hopeful traders who'd sell at the first sign of trouble. The base was now filled with committed buyers who'd just proven they were willing to step in when everyone else was panicking. That's the difference. That's what you can't see in a pattern scanner, but you can see if you're watching behavior. Think about a mechanical spring. If you compress it lightly, it doesn't store much energy. When you release it, it barely moves. But if you compress it fully, if you push it to its maximum compression point where it can't compress anymore, then when you release it, it explodes. That's stored energy converting to kinetic energy. Breakouts work the same way. A loose consolidation where price is wandering around, not testing anything decisively, not building tension, isn't compressing the spring. There's no energy. When it breaks out, it barely moves because there was never energy stored. But a tight consolidation that tests the same level repeatedly, where each test absorbs selling and holds, where the coil gets tighter and tighter, that's maximum compression. And when that breaks, it explodes. But here's the key. You can see the spring loading in real time. You watch price test support 5 times over 2 weeks. Each test, it bounces faster. Each test, the volume on the bounce increases. Each test, fewer people are willing to sell at that level. You're watching supply dry up. You're watching the spring compress. And then you watch for the catalyst. What makes the spring release? Usually, it's the moment when the last group of sellers gives up. When price stops finding sellers at support and starts finding aggressive buyers willing to lift the offer, that's when compression becomes explosion. And you don't need the breakout to happen to see it coming. You watch the spring load. And when it's fully compressed, you position before the release, not after. And this is where most traders go wrong. They're watching the pattern, waiting for the breakout to happen so they can enter. But by the time the breakout happens, the spring has already released. The easy money, the violent first move that happens in the first few hours or days after the break, if you're waiting for confirmation, you're entering after the spring has already exploded. You're buying the extension, not the breakout. But if you can see the spring loading, if you can watch the compression happen over days or weeks, you can position before the release. You can be in the trade when it's still consolidating, when everyone else is bored or frustrated, when nobody else wants it, and then when it breaks, you're already in at the perfect price. You're not chasing. You're already there. So if breakouts are about trapped traders, spring loading, and capitulation rather than patterns, what are the actual secrets? What are the 5 specific things you need to look for to spot the real breakouts before they happen? The first secret is volume behavior at resistance. When price tests resistance the first time, you usually get high volume. Makes sense. Lots of buyers trying to push through, lots of sellers defending. That test fails. Price pulls back. Then it tests resistance again. This is where you pay attention. If the second test has similar or higher volume than the first test and still fails, that's weakness. Buyers are trying just as hard but still can't break through. Sellers are in control. But if the second test has lower volume and still reaches resistance, that's strength. It means less effort is needed to push price up because there's less resistance. Sellers are losing conviction. And if the third or fourth test has even less volume and price is lingering near resistance instead of getting rejected hard, that's your signal. The spring is loading. Sellers have exhausted themselves. And when the breakout finally happens, it often occurs on a volume spike because what little selling is left gets overwhelmed instantly. This is how you filter. Most consolidations have random volume, no pattern. Those are coin flips. But when you see declining volume on upside tests while price holds near resistance, you're seeing the setup build. That's not a pattern. That's a structural tell. And let me be specific about what this looks like. You're watching a stock consolidate between $50 and $55. First test of 55 happens with 2 million shares traded. Price gets rejected. Second test happens a week later with 1.5 million shares. Still rejected, but notice, it took less volume to get there. Third test happens with 1 million shares. Price reaches 55 again, but this time it doesn't get rejected hard. It just sits there, hovering, testing. That declining volume is telling you something. It's telling you that fewer people are willing to sell at 55 each time. The sellers at that level are getting exhausted. They've sold what they wanted to sell. And the buyers pushing price up aren't having to fight as hard. Each push takes less effort. That's the spring compressing. And when you see that pattern, when you see effort declining but price still reaching the same level, you know the breakout is getting close. The second secret is the false breakdown that immediately reverses. This is the washout I mentioned earlier. Price consolidates, builds a base, then suddenly breaks down below support, stops trigger. Panic ensues. Everyone assumes the breakout failed. But then, price recovers. Immediately. Often within the same day. That's not weakness. That's strength in disguise. What just happened? All the weak hands sold. All the people who were hoping it would break up but weren't really committed, they're out. And someone bought all of that selling. Someone with conviction stepped in and absorbed everything. Now the base is clean. No trapped longs, no weak holders, just strong hands. And here's the tell. If price shakes out below support and then reclaims that level decisively, that's one of the highest probability setups in trading. Because you know everyone who is going to sell has sold, and the buyers who absorbed it are committed. They're not flipping for a quick profit. They're building a position. Most traders see that shakeout and think pattern failed, move on. But if you understand the mechanics, you recognize it as the final step before the real breakout. The spring just got compressed one last time. And now it's ready. And I need you to understand why this works psychologically. When price breaks down below support, everyone who is long and holding through the consolidation suddenly feels pain. Real pain. They're underwater. And their choices are either take the loss now or hope it recovers. Most people take the loss. They sell. They exit. They admit defeat. But here's what they don't see. That breakdown was a test to see who's really committed. And the people who bought during that breakdown, when everyone else was selling in fear, those are the committed buyers. They're not buying hoping it might work. They're buying because they see value. They see opportunity. They see everyone else panicking and they're doing the opposite. So when price recovers from that breakdown, when it reclaims support and pushes back into the consolidation range, you now have a base filled with committed buyers instead of hopeful longs. And committed buyers don't sell at the first sign of profit. They hold, they add, they push. That's what creates follow-through. That's what turns a pattern into a real move. The third secret is measuring volatility as the consolidation matures. When a consolidation begins, price swings are usually wide. Big up days, big down days. Range is loose. But as the consolidation continues, if it's setting up for a real breakout, the range should tighten. Each subsequent swing should be smaller than the last. The highs get lower, the lows get higher, and the range contracts into a narrowing wedge. This is compression. This is the market gathering energy. Every time a swing gets smaller, it's because neither side can generate enough force to push price far, but that energy is building. It's coiling. And when it releases, the move is often proportional to how tight the coil became. But if the range isn't tightening, if price is still making big swings within the consolidation, that's not a coiled spring. That's just noise, random movement. And those consolidations tend to resolve with a quick move followed by more consolidation. No follow-through. So you measure. You track the high to low range of each swing. And when those ranges are contracting systematically over time, and price is spending more time near the edges of the range instead of in the middle, you're watching the setup build. The apex is loading, and the breakout is close. Let me give you a concrete example of what this looks like. A stock is consolidating between 40 and 50. First week, it swings from 40 to 50, $10 range. Second week, it swings from 42 to 48, $6 range. Third week, it swings from 43 to 47, $4 range. Fourth week, it's bouncing between 44 and 46, $2 range. That systematic contraction is your signal. The market is gathering energy. Bulls and bears are in equilibrium, but that equilibrium is unstable. It can't stay this tight forever. Something has to give. And when it does, when one side finally overwhelms the other, the move is explosive because all that compressed energy releases at once. And you can see this happening in real time. You don't need the breakout to confirm it. You watch the ranges get smaller. You watch price spend more time at the edges and less time in the middle. You see the coil tightening, and you position before it releases. That's the advantage. That's how you catch the beginning of the move instead of the middle or end. The fourth secret is understanding that breakouts are often timing-based, not pattern-based. Every consolidation has a shelf life. And the longer a consolidation goes on, the more likely it is to break powerfully when it finally does. Why? Because time forces decisions. Think about it. If a stock consolidates for 3 days, not many people are emotionally invested. Most traders haven't even built a position yet. But if it consolidates for 3 weeks, now there are trapped traders. Now there are people who've been sitting in it, watching it do nothing, getting frustrated, their patience is exhausted, and exhaustion leads to capitulation. And here's the tell. When a consolidation extends beyond the typical time frame for that asset, when it should have broken by now but hasn't, that's when you pay closest attention. Because extended consolidations create maximum frustration, which creates maximum capitulation potential, which creates maximum fuel for the eventual breakout. I've noticed that the breakouts that run the farthest are often the ones that took the longest to set up, because by the time they break, everyone who was going to give up has given up. And the only people left are those with conviction. And conviction doesn't sell into the first 10% move. Conviction holds for the big move. And this is counterintuitive because most traders lose patience with extended consolidations. They think if it hasn't broken by now, it's not going to. So they move on to find something with more action. But that's exactly when you should be paying the most attention. Because the longer it consolidates, the more energy is being stored. The more weak hands are being shaken out. The more the base is being purified of people who aren't truly committed. I remember watching a stock consolidate for almost 2 months. Every week, people were saying this thing is dead, nothing's happening, move on. But I was watching the structure. I was seeing the volume decline. I was seeing the range tighten. I was seeing tests of support get absorbed faster each time. And I knew, this isn't dead, this is loading. And when it finally broke, after 8 weeks of doing nothing, it ran 60% in 3 weeks. Why? Because everyone who was going to give up had already given up. Everyone left was committed. And when the break happened, there was no supply to meet the demand. It just ran. And the people who'd been waiting for it to do something, who'd gotten bored and moved on, they missed it. They weren't patient enough to sit through the loading process. The fifth secret is learning to spot institutional accumulation. This is the hardest one because it requires reading between the lines, but the signs are there if you know how to look. Large blocks traded off hours, unusual options activity, consistent buying absorption at support. These aren't retail behaviors. Retail chases breakouts. Institutions build positions before breakouts. And here's what to watch for. When price consolidates and you see large green candles on pullbacks to support, but small candles on rallies to resistance, that's accumulation. Someone's buying the dips aggressively but letting price drift up slowly. They're building a position without pushing price away from them. And once their accumulation is complete, they stop defending the dips and start lifting the offer. That's when the breakout happens. You can't always see this clearly, but when you do, when you see large volume on down moves that don't lead to lower lows, when you see price getting defended at specific levels consistently, that's institutional behavior. And when institutions are accumulating, they're not doing it for a 5% move. They're doing it because they believe something significant is coming. And once you see them building the position, you know the breakout isn't speculative, it's structural. Let me tell you what this looks like in practice. You're watching a stock consolidate around a support level, let's say $30. Every time it dips to 30, you see a large green candle. Big volume. Price bounces hard. But when it rallies back up to 32 or 33, the candles are small, volume is light, price drifts up slowly. That's not random. That's someone accumulating. They're buying aggressively at 30, soaking up all the selling, defending that level, but they're not chasing it higher. They're letting it come back to them. They're building a position over time, using the consolidation to accumulate at good prices without driving price away from their entry. And here's the key. Once you see that accumulation pattern repeat 3 or 4 times, once you see that support level defended consistently with large volume, you know someone with size is involved. And they're not building that position to flip it for a quick profit. They're building it because they see something bigger coming. And when they're done accumulating, when they've built the position they want, that's when they stop defending the dips and start pushing price higher. That's when the breakout happens. So those are the 5 secrets. But knowing them intellectually doesn't help if you can't apply them in real time. How do you actually use these to position before breakouts happen instead of chasing them after? Start by identifying stocks or instruments in clear consolidation patterns. Not breakouts, consolidations. You're looking for assets that are range-bound, building bases, not trending. Add them to a watch list. You're going to monitor them daily for the 5 signs. This shifts your mindset from chasing breakouts to anticipating them. You're hunting setups in progress, not completed moves. And be selective here. You don't want 50 stocks on this watch list. You want 5 to 10 really clean consolidations, ranges that are clear, support and resistance levels that are obvious. You're not looking for messy, ambiguous patterns. You're looking for textbook bases where you can clearly track the 5 signs. For each stock on your watch list, create a simple log. Every time price tests resistance or support, write down the date and the volume on that test. After 3 or 4 tests, look for the pattern. Is volume declining on resistance tests? Increasing on support tests? You're quantifying the spring-loading process. This isn't subjective, it's measurable. And measurement removes emotion. And don't overcomplicate this. You don't need a spreadsheet with 20 columns, just 3 columns. Date, level tested, volume. That's it. And after a few tests, you'll see the pattern. You'll see whether volume is increasing, decreasing, or random. And that tells you whether the setup is building or just noise. For each consolidation, identify the level that, if broken, would trigger stops and shake out weak hands. It's usually just below the most recent consolidation low. Draw a line there. And if price breaks that level intraday, watch what happens. Does it recover? If it reclaims the consolidation within the same session, that's your signal. The shakeout held. Position accordingly. And this is where you need to be ready to act. Because when that shakeout happens, when price breaks down and immediately recovers, you have a very short window. Most people won't see it. They'll see the breakdown and assume it failed. But you'll see it as the final flush before the real move. And if you're ready, if you've been tracking this setup and waiting for this moment, you can position while everyone else is still processing what just happened. Calculate the high to low range of each swing within the consolidation. You don't need fancy tools, just a calculator. Write down the range size for each swing, then compare. Is each swing smaller than the last? If yes, the coil is tightening. If no, the setup isn't mature. This tells you whether to stay patient or move on. Most traders rush into consolidations that aren't ready. This prevents that. And this is objective. This removes guesswork. You're not asking yourself, does this feel tight? You're measuring. You're saying, the last swing was $4. This swing is $2. The coil is tightening by 50%. That's a fact. And facts help you make decisions when emotions are screaming at you to do something different. Once you've identified a consolidation with all 5 signs present, volume divergence, shakeout that held, range contraction, time exhaustion, and smart money footprints, you don't wait for the breakout to confirm. You position before the break. Set your entry at the high of the consolidation. Set your stop below the recent shakeout low. And when it triggers, you're in early. You're not chasing, you're anticipating. And that's how you capture the meat of the move instead of just the scraps. And I know this is uncomfortable. Every part of you wants to wait for confirmation, wants to see the breakout happen before committing capital. But that's why most traders miss the good moves. They're waiting for safety. But safety only exists in hindsight. By the time you're certain, the move is half over. But when you've done the work, when you've tracked the 5 signs and watched them all align, you don't need confirmation. You have structural evidence. You have volume divergence telling you sellers are exhausted. You have a shakeout that held telling you weak hands are out. You have range contraction telling you the spring is compressed. You have time telling you patience is exhausted. And you have smart money footprints telling you someone with conviction is accumulating. That's not hope. That's not speculation. That's structural analysis. And structure doesn't lie. So when all 5 signs are present, you position. And you position with conviction because you're not guessing. You're reading behavior, and behavior predicts price. So here's where we've been. You came here thinking spotting breakouts in advance was about pattern recognition. But what we've uncovered is that patterns are just shapes on a chart. They don't tell you anything about fuel, commitment, or intention. The real secrets are about market structure, about reading the signs that precede explosive moves, about understanding that breakouts happen when weak hands capitulate and strong hands overwhelm, not when triangles complete. We talked about the trapped traders principle, how watching a washout flush weak holders gives you conviction that the next move will be real. We explored the spring-loading metaphor, how tension builds through repeated tests and compression, and how you can see that loading process happen before the release. And we broke down the 5 secrets. Volume divergence at resistance tests, the shakeout that holds. Decreasing volatility into the apex. Time-based exhaustion, and smart money footprints. The practices, building consolidation watch lists, tracking volume patterns, marking shakeout levels, measuring range contraction, and positioning before confirmation. They all point to one truth. You don't spot breakouts by chasing patterns. You spot them by reading behavior. And behavior reveals itself before price does. Here's your mantra. Say it when you're watching a consolidation build. Patterns show me history. Structure shows me potential. I'm not waiting for the breakout to tell me it's real. I'm watching the spring load. I'm seeing the weak hands flush. I'm reading the footprints. And when all 5 signs align, I position with conviction, not hope. Listen, you're going to see a lot of consolidations, and most of them won't have all 5 signs. Most of them will be random noise pretending to be setups. And that's okay, because your job isn't to trade every consolidation. Your job is to filter aggressively and only position when the structure is screaming at you, when the volume is diverging, when the shakeout held, when the coil is tight, when time has exhausted the weak hands, when smart money is building. That's when you act. And when you do act, you act decisively. No second guessing. No waiting for one more day of confirmation. Because you've done the work, you've read the structure. And structure doesn't lie. Patterns can fake you out. Structure can't. If this changed how you see consolidations, if you're ready to stop chasing breakouts and start anticipating them, if you're ready to read behavior instead of patterns, do me a favor. Hit that like button. Drop a comment and tell me, what's one breakout you missed because you waited too long for confirmation? And subscribe, because we're building the analytical framework that turns you from a pattern follower into a structure reader. You've got this, not because you'll catch every breakout, but because you'll finally know which ones are worth catching before everyone else figures it out. I'll see you in the next one.